We lost everybody. If you are coming to this class to learn all of this, this is to teach you how to take the test. This is not to teach you how to do taxes. Okay, so tonight we're going to go over these next two chapters. Then next time we're going to go over estates, gift tax, and estate tax, 706, 709. You're not going to have hard questions about it. And then the following week, we're going to review everything. So you guys can, if you're going to take the test, you need to take it in the following week. So the week of, what is it, the 9th through the, no. Next week is the 9th. So the 10th is we're going to be here. Okay? Then on the following week, we're going to do review. And then the week of the, say, the 22nd through about the 27th would be a great time for you to schedule your test. Or if you think you're ready, you could schedule it early. If you want my help, I will be able to help you all the way up until about the 22nd, 21st.
You're fading out, and
Oh, well, I'm not, oh, you can't see me?
no, but it was your voice was, I don't know. It was just cutting out. I think you said the 22nd to the 27th.
I'll be gone. I'm actually going to Vegas for the NATP workshop on the 23rd and 4th, but that has nothing to do.
Okay.
Up until then, if you're ready to take the test and you need any help, let me know. Schedule time to come into the office and I will help you. If you're ready to take the test, or are you even getting close? If you don't mind, now, if money's an object in all this, you may not want to just take the test when you're not ready. If money is not important and you got plenty, go ahead and take the test and find out what you need to know more about. And you can see how the test works. But you can find out, if you can study all of the GLIME online has 1,000 problems. You can go through almost all those problems, and if you can make, let's just say 80 or 90%, 80%, you're probably gonna pass the test. If you make 90%, you're golden, yeah. Okay, so let's get going.
Sorry, when you say schedule that test that week?
Yes, between the 22nd and the 27th. Why? Because when we come back after that week, we're gonna start part 2 or part 3. Which would you guys rather do? Do you want to go ahead and tackle the second hardest? If everybody's think you're gonna pass the test, we might as well go ahead and take them in order and just keep, that means you're doing really good. If you're not, and you're just taking this, we used to have a lot of people that took this portion of it, not planning on taking the test, they just wanted to learn more about tax, especially part 1. When we got to part 2, we gave them a headache and they'd drop out. I'm not sure where everybody, well, this lady is always late. Bay, who knows? And there's another lady here.
Just that's always our one.
Yeah.
The
We
two
had a
ladies- the
full-
two ladies are missing.
Yeah, they missed last week too. Oh, there we go.
Like clockwork.
Rico.
I'm here. I move.
Albert. Maggie. Judith. Okay. Gemma. Oh, Gemma. I'm not who knows? Okay. And Alexis has been coming fairly regularly too. Okay, so let's get going.
What chapter are you on?
That's what I'm trying to figure out. I think it's 9 and 10. No? Chapter 10 and 11. And next week is 12 and 13. Chapter 10 is 285. Page 285. And the first is going to be somewhat the easiest part. Okay, so if you have your personal home, you get what's called a Section 121 exclusion. You get $250 for yourself, and if you're married and you meet all the qualifications, you get $500,000. That's a big deal. So let's go over the rules on that page. Okay, Section 129 exclusion. What is it? You got to own it and occupied it as your principal residence for 2 out of the last 5 years. Does everybody pretty much know this stuff? Okay, I'm going to go over it because they're going to ask you, that's going to be it. Do both of you have to have owned it for 2 out of 5 years? And the answer is no, just either one of you. Do both of you have to have lived in it? Yes. To get the exclusion for both of you, you both have to have lived in it 2 out of the 5 years. Okay? You can only take the exclusion once every 2 years. So, and they're going to give this as one of the little questions. I get married to somebody. That person had taken the exclusion a year ago. We sell the house. Only the one guy that hasn't taken the exclusion the last 2 years gets the $250,000. Everybody pretty much knows that. Okay? If you have a surviving spouse, she gets 2 years. If she sells a house within 2 years of her husband passing away, she gets the full $500,000, assuming they both meet the use and the ownership test. Okay. If you have a physically or mentally incapacitated person, your mom gets demented, you put her in a private home. Well, she's deemed to be living in that, and if she lived in it at least 1 year during the last 5 years, and you sell the home, you get the exclusion. If it's just your mom, you'd only get a $250,000 exclusion. Okay? Exclusion can be prorated for certain things. What is it? Employment. You have to move to Timbuktu because your job requires it. You lived in your house for, let's just say 1 year to make it easy. So you would get half. Okay? You lived in it 1.5 years, you get 3/4. Okay? Besides unemployment, it could be health or unforeseen circumstances. Okay, so you get really sick and they go, you can't live in Hawaii, it's too hot, you gotta go live in Minnesota. I don't think there's something like that, but just in case, you got a doctor say that, you had to leave, you'd have to sell your house. That exclusion. Unforeseen circumstances. Your parents get sick. You have to go live with your parents. Take care of them because they're demented. So you've had your house for 1.5 years, you have to sell it, so you'd get 3/4 of the exclusion. Has everybody pretty much got that? Non-qualified use. If after 2008, you live in it for a bunch of years, then you move out and rent it for some years, then you move back in. Some of those years in the middle were non-qualified. It was a rental property. Or, it doesn't have to be a rental property. You just left it vacant. Or you let your kids live there. Or you let your sister live there, but you didn't live there. So you would have non-qualified use, and you might have to prorate that. And let's just say the gain would be this. I did a little problem. Let's just put this up here. I don't think they're gonna get you something this tricky, but you sell the house for 600 grand. Okay. The house cost you 300. So you made 300 grand profit. You lived in the house 3/5 of the time, 3 years out of the last 5. You didn't live in it 2 out of the last 5. Okay? So, so 3/5 of this gain you get to exclude. Say 3/5 would be 180. So that would leave 120. So you would have a taxable capital gains of 120 on the house. Okay? That's if you lived in the house. Let's say you lived in the house for a year. You moved out and left it there for 2 years. I'm saying that as opposed to a rental because we don't want to have to put depreciation, recapture, and make it more complicated. But then you move back in for 2 years. So you lived in it 3 out of the 5 years. Nobody lived in it 2 out of the 5 years. So you can only exclude 3/5 of the gain. Okay? And you have to pay tax on 2/5. Everybody got that? That's liable to be a problem, but that would be a sort of a hard one. That would be, you're not gonna have a lot of hard ones. Okay, here's another thing. This is the good deal. Okay? I live in my house for 4 years out of the last 5. But the very last year, I move out and rent it to somebody. Okay, so if we look on the bottom of non-qualified use under A, under 11A, non-qualified use includes periods that the relationship was not used as a principal residence of the taxpayer prior to the last day the homeowner moved out. Okay? I believe, I think there's somewhere else that it says that last year, you don't have to count that as non-qualified use. You get the whole 2 out of 5. During the 5-year period, the town has for years 2, 3, and 4 during the absence. Non-qualified use includes periods that the residence was not used as principal residence of the taxpayer prior to the last day the taxpayer lived in the house. So if the taxpayer didn't live in the house the last year, you don't have to count that last year. That's what I'm trying to tell you. The reason I know this is that a couple of months ago, I had a guy come in. He's had a falling out with his daughter. He was renting her his house that he'd lived in. He and his wife got a new one. She cut down all the trees in his backyard, just without permission that he and his wife lovingly had planted not so long ago. They'd grown up, and they go, well, and I don't know what their excuse was, but they did that and they did a bunch of other stuff without asking. and they were just renters. So the guy kicked him out, he's now selling the house. I got an email a few days ago, it wasn't to me, it was to everybody he knows, saying, if you know anybody that wants to buy a house, I'm selling this house, and that's the house. And I'm gonna be showing it to realtors in about a week, and if you know them, tell them to call me right now, and you'll get a good deal.
Does he have an agent?
Huh?
Does he have an agent?
Yes, well, I don't really, he said, the agent's coming over here next week to look at the house. Are you a real estate person? Okay. I don't know him well enough to like say, oh, do this, do that. And it's up in, what is that, kinda like above St. Louis, the high area?
Wilhelmina, right?
Yes,
Wow. For how much?
Now it's buying.
million.
800. 600.
Yeah, right. You guys do your own negotiating. Okay. But anyway, so, and I looked that up for him. And so he's lived in there more than the last 3 years. His daughter has lived in there less than 2 years. He lived in there all the time before that. So he's not gonna have to, and it's less than a $500,000 gain, so he is not gonna have to pay tax on this because of that. Prior to the last day the homeowner lived there, that's the key. Okay, so principal resident requirement, it has to be your principal resident. So if you've got somebody here that comes into you and go, yeah, I'm selling my house in California, and you tell them that rule, and they go, oh no, that's my principal resident. And you look at their tax return going, you filed Hawaii as your residence for the last 3 years, you're dead meat. They can't be doing that. You understand what I mean? You can say, now, if you had a house, one in Nevada and one in Texas, where neither place had you filing taxes, you might be able to shuck and jive like that. But in Hawaii, you can't. If you claim you're a Hawaii resident, you're not gonna be able to sell another home in another state as your personal residence. What do we mean personal resident? That's what I'm really trying to get to. Is your main home. You only get to have one. So if I have people that do this, they move back and forth between here and California. They got houses in both places. And they're trying to say, which is my personal residence. Somebody did this out in Kapolei a few months ago, and I went through the same spiel. It's gotta be your main home. They'd claimed last year California is their residence. So selling a place in Hawaii, they can't claim that as their residence. It was the other way around, okay? So that's important, right? Okay, so how much do you, if you have a home, and in your home you have an office and home, then when you sell your home, the office in your home, you don't have to declare that as a separate place. You only have to recapture the depreciation you've taken. If you had taken the simplified method for your office and home all this time, you don't recapture anything. Everybody, you're familiar with office and home. You can either do the actual or you can use the simplified method. You know what I'm talking about? For office and home, simplified versus actual. The simplified method, you get to write off $5 per square foot of your office and home up to $1,500 or 300 square feet. Your actual, you take the office and home number of square feet, total square feet, I have an office in my home, we're gonna go 200 square feet. My home is 2,000 square feet. That's being very generous. That's a big room. Okay? Or 10%. If I'm renting that home for $3,000 or $36,000 a year, I would get a $3,600 write-off on my rental property right? For office and home, I would reduce, let's just say your Schedule C. Okay, I would reduce my income on my Schedule C by $3,600. If I was in a 22% tax bracket, 15% self-employment tax plus 8, that would be 45%. I just saved myself a bunch of money, about $1,500. Okay, on the other hand, and the same thing, if my utilities were 300, then it would be 360, and you'd save yourself about 45%. Now, instead of renting your home, what happens if you actually live there, your office and home? Okay, you own the place. So you could still write off 10%. You'd write off 10% of your mortgage, 10% of your utility bills, 10% of your insurance, 10% of your property tax. Well, the property tax and mortgage you could have already written off on your tax return. Except, remember, property tax is now limited to $10,000. So then you might get a benefit by writing off 10% of that here. If your property tax was $4,000, you got to write off $400 here. That would save you your $4,000. If your income was over $6,000, you don't get it all. So that's a good advantage. You also get to depreciate your home. What would you depreciate your home over? This is a business. This is not a rental property, so it would be over 39 years. So your house minus the land was $390,000, and divide by 39, so you could write off 10 grand a year. 10% of it was your office and home, so you would actually get to depreciate $1,000 on your office and home. That depreciation of the $1,000 of your office and home, you would have to recapture. None of the other expenses for your office and home would you recapture, but that depreciation you would. Okay, I didn't go through it. Now, that's how you had an office at home. On the other hand, this is your house, but you had another little grandma house out here. Well, I don't know what they call them here, but a little house that you made for your huh?
I can't hear you at all.
You can't, well, I'm talking loud.
No, I can't. It's internet's out.
I don't know what you're saying.
Okay, well, I can't hear you. I can hear you, and then all of a sudden you'll say a sentence, and the sound is gone. So it sounds to me like a loose connection.
Okay. Can you put this collection in the wall over there, make sure you're not, you're kicking the thing.
No.
Yeah, your foot was on it just now. Okay. Hopefully that works for you.
That's it. It's real good.
Yay! It was you were kicking it. All right, so you have a house. You have a little bitty other house over here that's not connected. Your office and home, if it's in here, that's one set of rules. If it's out here now, you have a separate one. So you would still depreciate this, you'd still write it all off, but now this is a separate, and we'll say this is 1/10. So now this 1/10 is a separate building, and you would depreciate it, write it off, and when you sold it, if you sold it for $1 million, so this would be 90%, and this would be 10%. So $1 million, that means you'd be selling this one for $900,000, this one for $100,000. You take your basis, this would be 90%, this would be 10%. So if you bought it for $500,000, this would be $450,000, this would be $50,000. You see how this you would depreciate completely different. They're not going to give you a question like that very likely, because that's too complicated. But what they would do is ask you do you have to recapture the depreciation when they're separate houses? The key concept is two separate houses.
So no. The answer is,
Huh?
what would the answer be, yes or no? Do you have to recapture two separate houses if they're two separate?
You would separate and you'd have a sale of one little house and a sale of the big, you'd have two separate sales. You'd have sale of the office and home, that would be completely separate. Everything would be separate. If it was inside your home, it's not. Only recapture the depreciation. Okay? Okay, so now we're gonna go to this sheet. Can you see that, Lisa?
Yep, I got it.
Okay, this is everything. A lot of your questions are gonna be based on this. Yesterday, or last week, I talked about realize and recognize. All the questions are gonna have at the bottom, how much did you realize? How much did you recognize? Realize is the actual gain, recognized is the taxable gain. How much do you pay tax on? So, if, I sold my house for 100 grand. My house cost me 70 grand. I did not live in it 2 out of 5 years. I would have 30 grand. How much did I realize? Everything that I got for selling the house is how much I realized. Everything I got minus the selling expenses. So we're not gonna have any selling expenses on this one, but the next one we will. So on this one, they gave me $100,000. That's everything they gave me. My house cost me $70,000. I didn't have any depreciation, I just lived there. Okay, but I didn't live there 2 years, and the reason I moved out is because I wanted to go move in with somebody. Okay, so I made $30,000. The amount I realized, the realized gain is $30,000. It's also the recognized gain. I have to actually pay tax on it. Everybody got that? The same deal. I sell it for 100 grand. I bought it for 70, but I lived in it for 2 out of the last 5 years. So if they ask me, how much did I realize on this? The answer is 30,000. How much did I recognize? The answer is 0. Because I get a $250,000 exclusion because I lived in it as my main home for the last 2 out of 5 years. This is the key up at the top, realized and recognized. Gain. Okay, so every problem you do, if you haven't already gone through and done them all, take this sheet of paper and write them out. Don't do them in your head. Write down the dates. They're gonna trick you with dates. So the one trick they do every test is they say, oh, I bought something on July 7th, I sold it the next year on July 7th, short-term capital gain, long-term capital gain, ordinary income, what? And the answer is, if you bought it on 1 year, it's not more than a year, it's short-term. Short-term capital gain, it's actually ordinary income. If you use short-term, it's ordinary income, okay? It's a trick question. I've been caught on lots of trick questions before because I've been doing this for years and I do them fast and then I make myself stop and write it all out and I do a lot better because then I figure out, what's the question? That's another thing. You got to figure out what are they really asking for. So, okay, so what we've got, there's no like kinds change in this. So, The first thing you wanna know is how much did you realize, how much do you recognize? The next one, on every problem, you wanna calculate how much of it is ordinary income and how much of it is capital gains. We don't know. If he's owned it for 2 out of the last 5 years, it's definitely capital gains, right? He owned it, lived in it, so that he gets to have the 121 exclusion, so it's capital gain. If I bought it for 70,000, sold it for 100 grand, made $30,000, we don't know if it's ordinary income or capital gains unless we know the dates. Okay?
Something happened with the speaking with the connection.
I'm not touching anything.
Okay, well, he's not touching it now.
Come over here, come over here.
Thanks.
Huh?
Weird.
I'm sideways already.
I don't know, Sam's not here.
It's a many hoonies.
Yeah. Okay, we've got the camera going in the back under worst conditions. Sam can send you the stuff tomorrow.
Okay, great, thanks.
Okay. Okay, so we'd have to know the dates to know whether it was long-term or short-term, right? Okay, let's start the next one. I sold it for 100 grand. I bought it for 70 grand. It's a rental house. I rented it out for several years, and my depreciation is 20,000. So my basis is 70,000 minus the depreciation, 50,000. Everybody with me? On every problem, I want you to go through this. You go basis, beginning basis, additions or improvements, minus depreciation. So it's beginning basis, what you paid for it originally. If we had any improvements, we don't have any. We'd have improvements. That would be plus improvements. Minus depreciation gives you your basis. Then over here, you would say sales price minus cost of selling. So we're gonna make it up that we had $5,000 is our cost of selling. So actually we netted $95,000 in selling it. How much is that? That's what we realized. Okay? We sold it for 100 grand minus the expenses. We realized 95,000. Our basis is 70,000 minus 20 or 50. So we have 45,000. Okay, so we realized 95,000. Our basis was 50,000. Subtract your basis from what you realize and you get your gain. This is your realized gain. In this case, it's also the recognized gain because there's no gain exclusion. If we had this property, well, first of all, it can't be your personal residence because you're depreciating $20,000, and I think I said it's a rental property. So you've got a $45,000 gain. So now you have to say, what kind of gain? What's the character? The character is the first $20,000 of depreciation is recaptured as ordinary income, and the rest is capital gains, assuming we had it over a year. Okay, does everybody get that? So how many questions can they answer off just this? They can say, how much did you realize? I realized 95,000. What is the basis? The basis is 50,000. What is the realized gain? $45,000. What is the recognized gain? $45,000. What is the character of the gain? $20,000 ordinary income, $25,000 capital gains. Does all that make sense? These are gonna be your questions. We just took a third of the questions and answered them. Okay, so let's sit down for a second. So now that is capital gains without a like-kind exchange. So like-kind exchange changed this year. Before, you could have a lot of different kinds of like-kind exchange. You could change a truck for a truck, a machine for a machine, a rental property for another rental property, a rental property for just land, a rental property for a business, building, not a business, but a building, okay? Reporting for okay, on the bottom of 287 it says under 15, the amount of realized from a gain is less than the maximum exclusion amount. The gain need not be reported. That would only apply to what?
That's the one with that?
Yes, but it's not true. It's normally if you have a principal residence and your gain is less than the 250,000, and so you don't have to, there's no recognized gain, you don't have to. But if you get a 1099-S, the rule is you have to report it. Okay, although our book doesn't say that, it's true. Now we're turning over to 288, like-kind exchanges. Starting now, only real property applies. And what a lady told me that was, she was an exchange person, an exchange facilitator. She goes dirt for dirt. If you've got rental property for a building, that's dirt. They're both on dirt. You've got land for a rental property, dirt to dirt. Okay, mostly, okay? And I don't know how much they've changed from that. She told me that 10 or 15 years ago. One other rule, there's a lease rental property of $30 years or more is treated as real property. They wouldn't have a problem like that, but they might have that in one of the answers. So a lease of 30 years or more is, think of it, you lease a building for 30 years, think of it as you owning it. Okay? To do this, you've got to own the property. You can't have a lease normally. Okay. If you'll go down to C, there's a list of things that don't qualify. The following property does not qualify for 1031 exchange. That would be, you can't change your building for money, you can't for account receivables, liability, inventory, partnership interest. Partnership interest, there is one exception, I can't remember what it is, but mostly you can't do a change between two partnership interests. You can only do them now, it has to be dirt. It has to be something that's on dirt. Or any personal property. Okay. So let's go, now we're gonna go to the real stuff. Boot is what they call boot. Okay, first, a like-kind exchange. I have a building that my basis is 400 grand. I want to trade my building for a building that's got a basis to the other guy of 350, but a fair market value of 600. Okay, so I'm getting $600,000 worth of building, and he's getting, my basis is 400. Well, my fair market value might be 600, or it might be 700, or it might be 200. It doesn't matter. I'm giving up my basis 400, and I'm getting his property at 600 at his fair market value. So what am I getting? Everything I realize. In this case, I'm only getting $600,000. So if I get 600,000, my basis according to this, I realized 200,000, but I recognize 0. This is a like-kind exchange. I'm changing a building for a building, a like-kind exchange. Now, my basis in the new building, we're going to go through this in depth in a minute, but my basis in the new building is, we start off with my old basis plus any boot that I get minus any gain, minus any boot that I get plus any gain that I recognize. Well, I'm going to recognize 0. I didn't get any boot. He didn't give me anything else. So my basis in the new property, even though it's worth 600 grand, is going to be 400 grand. So it's the same thing. You're going to have to know all this. We're going to go through the whole bunch of it. So let's go to the next one. The next guy, I still got my 400,000 piece of property. But the guy says, and I go, let's just say my fair market value is 700 grand. Although that 700 grand doesn't mean anything in the calculations. They're going to put it in there all the time to try to trick you. Don't fall for that. Okay, so my basis is 400 grand. So the guy says, I'll give you my property that's fair market value of 600, and I'll give you $50,000 of cash. So now he's given me, what has he given me? What did I realize? I realized 600,000 and 50,000 of cash. So now I realize 650. I would have $250,000 of realized gain, recognized gain. There's a rule that says you have to recognize gain up to the amount of all the boot. What does boot entail? Boot entails he gives me cash, he gives me some other asset, gives me a pickup truck, he gives me loan relief. If I had a mortgage on my property and he pays my mortgage, that would be loan relief. Then minus any selling expenses. That's the whole kit and caboodle. Okay, so we're going to do this to make this. So he's now going to give me $600,000 plus 50,000 cash plus a truck that has a fair market value of 20,000. It may only have a $10,000 basis to him, but that doesn't matter. Then I've got $5,000 of expenses. So he's going to give me $665,000. Now, I realized 650,000. 600 plus 50 plus 20, 670 minus 5, 665. So I would have a gain of 265. I realized 265. How much gain do I recognize? On the piece of paper over here, it says, recognize gain in a partial non-taxable exchange. It's the total of cash, loan relief, unlike kind assets such as a truck, less selling expenses. So, cash, truck, selling expenses, that would be 65,000. I would have to recognize a gain of 65,000. Okay? That's because this is land. If this is depreciation, and how would I recognize that gain? That gain would be all capital gain. Because there's no, assuming I had this more than a year. Question? Okay. Let's say that I had 70 grand worth of depreciation. Okay, so now my gain is 335,000. So what would I get? 70 plus 265. So the first 70 would be recaptured as ordinary income, and the last 265 would be capital gains. Everybody got how that's going to work? This is going to for sure be a problem that you're going to get. One combination or the other. In another 10 minutes, we're going to stop, and I've already done a bunch of problems for you, and we're just going to slowly go through it to make sure you got it. Okay? So, one more. So the last thing we haven't put in is a loan. Okay, so what do we have here? 600 grand. He has a $80,000 loan. I have 400 grand. I have a $100,000 loan. He takes over my loan. I take over his loan. His is bigger than mine. So I, in effect, got $20,000 of boot, of extra money. So he gave me 600 grand plus 20,000 of loan, or he gave me 620.
What's your real money?
Huh?
No?
That, okay, I realized $620,000 for the sale. Okay? You're netting these off. In most problems, it's not gonna be that way. They're not gonna have it with him alone. They're gonna go, I'm taking over his 100 grand, so now it's gonna be 700 is how much? 100,000 in loan relief that I got out of, and the 600,000 of land that he gave me. In effect, he gave me $700,000. My basis is 400, so we have a $300,000. Okay?
So what do you call it, 300,000?
That would be that's your realized gain. So he gave me a 600 plus 1, he gave me 700,000. My basis was 400, so we actually made a profit of 300,000. Realized gain. How much is that recognized? It's only recognized up to the boot, this 100,000. So realized gain would be 300. If they ask what's the realized gain, the answer is 300. If they ask what's the recognized gain, the answer is 100. We've just now pretty much gone through every one of the problems for the gain. After we go through this again, I'm going to go.
So the 100 is taxable?
Yes. And because there was no depreciation, it would be capital gains. If it had been depreciation in there, then you'd take the depreciation out as ordinary income, and the rest would have been capital gains. Okay, let's just keep going through the book and then we're gonna do the next. Okay. Okay, so what are the rules on this like kind of exchange? Well, you gotta do
What page are you on? 289?
289. So the boot, they have a, say, what is boot? Boot is what we're talking about. Other than the property, what is it? It's either cash, net, liability relief. If I have a liability, he has, it's the net. If other qualified assets, he gives me a truck on top of the cash. And then it's I didn't do it, but now we get through this whole thing and we've got recognized gain of 100. You would say less any expenses. I didn't complicate it by putting, but always subtract the expenses. Remember, if they put expenses in there, that's gonna be subtracted on your recognized gain. All right, so let's go, what are we talking about? So here's on 289, basis, they say, adjusted basis of property given. Gain, this is how you calculate the basis of the acquired property. In my sheet, it's this area right here. It's approximately the same. The basis of the, where you start is the basis of the old asset, the gain recognized. I do it just the opposite. I go, boot received is subtracted, okay? Less any money or loan relief, okay? Loss recognized of unlike kind exchange. We'll go over that possibly. Gain plus gain recognized. You'd add the gain recognized and the boot given. Okay? So we're gonna go through this. Okay, so the IRS has ruled that exchange expenses can be deducted to compute gain or loss. So what is that? Besides the closing cost, you're gonna have to pay the like kind exchange people that do the like kind exchange. They're gonna charge you. That's closing cost part of it. That's what. Okay, so what are the rules? First, you have to say what the identity of the place that you're going to exchange for within 45 days of closing. It has to be clearly described in a signed written document. So you've got 45 days. I sell my property, I've got 45 days to say which property am I selling it for. Okay? Then I have 180 days or the closing of the tax year plus extensions to get the deal done. So if I do the deal on September 1st, I'd have September, October, November, December, January, February to get it done. 180 days. Or the close of the tax season, which would be April 15th. No problem, it's after 180 days. On the other hand, hello? Can you hear me?
Now I can. I didn't a minute ago.
Maybe when I lean back, I'm not in a good spot for the microphone.
Yeah, that's a great spot, thanks.
Stay right here. Don't move.
Don't leave.
Don't move. Okay. So you've got 45 days to say what the property is you're going to trade it for. And you can also you can list more than one property. I'm going to trade it for this property, or this property. But you got to put it in writing. You got to say what it is. Then you got to actually buy the property within 185 days 180 days?
Mm-hmm.
180 days, or the filing, the date of filing for the tax return, and with extensions if you get an extension. So, if I, let's say, just say December 1st, I sell the property. I have 45 days, which would be about January 15th. I've got to say what the new property I'm going to buy. Then I have to either get it closed 180 days from December 1st, or the filing deadline, which is less than 185. April 15th is less, unless I get an extension. So you better not mess up and forget that extension, or your client could be upset.
So 180 days from what date?
The day you sell the first property,
Okay.
to get the second property bought. You have to have said what the property is within 45 days. You gotta get the deal done within 180 days, or the filing deadline, or the filing deadline with extension. They're gonna ask that question some way, and it'll be a multiple choice. One of these is not right, and instead of 45 days, maybe they'll say 50 days. Instead of 180 days, they'll say 160 days, or they'll do something to trick you. Related parties, okay? If I do a like-kind exchange with my dad, that would be kind of hard, but if he was still here, if I did a like-kind, and either one of us sold the property, then within 2 years, that voids the deal, and we would have to pay tax on it. So, even if your brother, say you have a rotten brother, he goes, sell me this property, blah, 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 and you go, I don't know, and he goes, yeah, I'm okay, I'm a good guy, I've quit drinking, I've quit doing everything, and then a year and a half later, he sells it, he lied. Your goose is cooked, you have to do, yeah. Okay, another thing you need to know is what is the form we use on a like-kind exchange? 8824. That's a simple question, so as long as you make sure you know 8824, because that's an easy one. When they give you those questions, they do this throughout. Every now and then they just ask you, what form is it? You know, they do it a lot with next week's gift tax. Which is gift tax? Which is estate tax? I think estate tax is 706 and gift tax 709. But everybody gets those two forms mixed up all the time. They ask that question, and you go, "That's a gimme. That's great." Finally, they ask an easy one. Okay, reporting involuntary conversion. What happens? You're not doing a like-kind exchange, but you have an involuntary conversion. Trump wants to build a wall on your ranch. He just takes your land and sells it to you, whatever. Well, that's not nice, but we'll see how that goes. Okay, non-recognition of gain. If you buy within 2 years other similar property, it doesn't have to be like-kind, and it doesn't even have to fit the rules of like-kind property. It can be your personal house. You can defer the gain on it. You have to spend at least as much as you did on the original property. Okay?
Say that again?
I own a house. I lose it in a hurricane. I get somebody, the city wants my land. Okay? So you have an involuntary conversion. But after they give you the money, you got 2 years to go out and find another piece of property similar and pay as much for that property as you did for your old one, and you get to defer all the gain. If you don't pay quite as much, you can defer most of the gain, but not all of it. So if you sold your property for 200 grand and you went out and you can only find one for 180 grand that you wanted, well, you're 20 grand short. You'd pay tax on that 20 grand, but you wouldn't have to pay tax on the rest of it. It would be deferred. All right, so it's right now is the next chapter is going to be a little shorter, so we're going to spend an extra little bit of time going over this, and we're going to go over the second half. We just went through all the different ways of doing how to get the realized, the recognized, whether it's ordinary income or whether it's capital gain. Anybody else like to go to the restroom real quick? Okay, we good? Do we need any kind of chart? We don't take smoke breaks. All right? So, let's pull this piece of paper up again. So you guys, you need to, so hopefully you've now you've memorized the top half. So, is my math correct? I try to make myself not do this, just doing these off the top of my head. So, you had your basis is 400,000, you had 30,000 of depreciation, your adjusted basis is 370. So 600, 650, 670, 665. So you have $295,000 of gain. How much did you realize? You realized 665. Your basis, 370. Your realized gain is 295,000. How much is your recognized gain? Your recognized gain is on the sheet of paper, recognized gain. On a partial, okay? It's the cash, loan value, other like kind assets, less selling expenses. Cash, loan value, there's no truck on there, minus your selling expenses. So you would have $65,000 of recognized gain. It would be 70 minus the selling expenses. So, right?
You don't add this.
You guys need to memorize this and know it, so you can do on all of these problems, you put it on paper and do it according to this. And while you're doing the practice problems, have this there with you. Don't try to just do it with this until by the time you're done, it's like second nature. This is my personal opinion. Any relationship to reality is strictly coincidental. Okay, so 295 is your realized gain. So if they ask you what your realized gain is, you would say 295. If they say what's your recognized gain, $65. Recognized gain. Okay? What is the recognized gain? 30,000 of it is ordinary gain and 35,000 of it is capital gain. We've now gone down through half of this sheet. Okay? Let's just keep going. Basis of the new like kind asset. you start off with the basis of the old asset. The old asset was $370. Less money and loan relief received. That would be $70,000. Okay? Plus gain recognized and cost incurred. How much gain did we recognize? 65,000 plus the cost incurred is 70,000. So now that $600,000 piece of property has got a basis of $370. By coincidence, it's the same as this right over here. It's not going to always be that way, but a lot of times it does come out sort of. But you don't do that. Don't skip and just guess. Because everybody, we just went through everything. So now, the next question they ask you is, what is the basis of the new asset, of this asset? Even though it's got a fair market value of 60 plus you got 50 cash and loan, the asset, you pay tax on all the rest, so that new asset is worth $370,000, and you would start depreciating it at $370,000, unless there was some land involved. Then you'd have to take that into consideration. All right, everybody has an idea. Does this all make sense? We've now gone all the way through this. Now we're going to take this piece of paper and go through a couple of land sales that I brought. We've already got it all written out, so it's going to be really easy, and you won't have to worry about my bad handwriting. It's all typed. Okay, starting with problem number 1. Mr. Obama sold a rental house to Mr. Trump for $700,000. Okay, so what is the realized amount that Mr. Obama got? Everybody? $700,000. Good job. How much? So the house, Mr. Obama's house, it cost him $250,000. He made $35,000 worth of improvements. He's had $60,000 of depreciation, and he had $10,000 of selling cost. Okay, so how do we do this? We start with the amount realized. On here, amount realized at the very top, it says sales price is cash, loan relief, fair market value of assets received, less selling expense. So all he got was cash, right? So he got cash minus the selling expense. So what is that? $690. Do you have the piece of paper with you?
Yeah.
Okay. So the amount realized, does everybody see that on there? Amount realized $690. The basis, how did we determine it? We go cost of the house plus improvements minus depreciation. So the basis of the house is $225. The realized gain is the difference between the two, $465. Okay? Is this a like kind exchange? No. He just sold a piece of property for cash. That's just a regular sale. So the realized gain and the recognized gain are the same. What's the character of the gain? It's ordinary income of $60,000 with depreciation, and everything else, the $405, is capital gain. And the way you figure out capital gain, you take the realized gain minus the depreciation, or minus the short-term gain, and the rest of it's long-term gain. Everybody got the first one?
The 405 is a long-term gain.
Yes. So here's what they could ask you on that. How much did he realize? He realized $690. What's his basis? They could ask you, basis $225. What is the realized gain? Okay. What is the character of the game? And they would say, you know, ordinary gains 60, ordinary gains 0, capital gains 465. They'd have all the different answers.
Where's, they say, what's the adjusted basis?
The adjusted basis is 225. The adjusted basis of the house that was sold is 225. Okay, there is no adjusted basis of the house that he purchased because he didn't trade for a house, he got cash. There is no new basis. So the bottom part of this wouldn't be used at all. Okay, number 2, Mr. Obama sold the same rental house to Mr. Trump. This time he sold it to him for $7,000 plus a rental house basis of $300 and fair market value of $550. So what does Mr. Trump, what did he sell? What is the realized amount that Mr. Obama got from Mr. Trump? He got what? He got a house with a fair market value of $550 and he got $7,000 of cash. Does everybody see that? His basis is the same $225,000 it was in problem 1. So now he has a realized gain of $332,000. Realized gain. If they ask, what is your realized gain? It's $332,000. If they ask, what is your recognized gain? Your recognized gain is $7,000. I didn't put any selling expenses in there, but if, let's just say I put in $1,000 of selling expenses, then he realized instead of $557, he had realized $556, $1,000 of selling expenses. But his recognized gain, you'd also subtract that from the recognized gain, so his recognized gain would only be $6,000. You see how that works? You subtract the selling expenses from the recognized gain. Under it says recognized gain, halfway through your page, it says, what's the recognized gain? The total of everything you get less selling expenses. Don't forget the selling expenses when you subtract it right there. Okay? In this problem, there isn't any. But I'm throwing that in there just to help you. Okay, number 3, Mr. Obama sold the same rental house to Mr. Trump for this time $70,000 cash, a truck with a basis of $12,000, and a fair market value of $21,000, a rental house of $550,000, and Mr. Trump took over a mortgage of $65,000 on Obama's house. Selling expenses $10,000. This would be the hard one if they give you a hard one. But let's go through it. So let's start. What did you realize? Add up everything. He got a house, I got a property worth $550,000. He got $65,000 of loan relief from Mr. Trump. Mr. Trump took over his mortgage. He got $70,000 of cash. He got a truck with a fair market value of $21,000, and he subtract the $10,000 of selling expenses. So all in all, he got $696,000. That's what he realized. Everything he got is what he realized. Everything he gets minus selling expenses. The same, he's giving away the same piece of property again. $225,000 is the basis, so his realized gain is $471. Does everybody get that part? So if they ask realized gain, $471, they're going to ask that on at least 1 or 2 to trick you, because you're going to be working, doing all this problem, getting it up, thinking it's a like-kind exchange, and they're not asking you that. They're asking what he realized. I remember getting caught on that a few years ago, and on one of the practice, it was a practice problem, so it didn't really matter. Okay, so What is the recognized gain? Recognized gain is all the boot minus selling expenses. So that's not the land. So the 65,000, the 70,000, the 21,000 minus the 10,000. Does everybody see how that worked? That comes to 140,000. So he has to recognize 140,000 and pay tax on it. He's still getting a good deal. Of course, we don't know. His basis is only 225. That property has maybe have a fair market value of $1 million. Then he's not doing so well. Okay, out of that recognized gain of 146, how much of it is ordinary and how much of it is capital gains? They're gonna ask you those two questions. And what would you do? You'd look back and say, 60,000 depreciation, ordinary income, the rest is capital gains. Everybody got that one? Now, let's go see what's the basis of the new property. You get this from down here on the bottom half. You start basis of old property minus cash received minus loan relief plus gain recognized. Huh? What's that?
I couldn't hear anything that just happened for the last minute.
Leaning back.
What's that?
You were leaning back.
Oh, I leaned back again, okay. Okay, do you see the piece of paper on Mr. Obama number 3? I'm going down that piece of paper. I say a basis of the old property, 225. And what you're doing is, if you look at it, it goes, you would subtract money and loan relief minus 65,000 minus 70,000 plus gain recognized plus selling expenses gives you a basis of the rental property and truck of 246. Then you subtract the truck at fair market value. Now you have the basis of the new rental property at 225. It's a coincidence, but it happens a lot. It's the same as you started off with the old property. Has everybody got that pretty much? Lisa, you got what I'm?
Yeah,
This is the complicated one.
Like this, they would actually give you in the test that give the adjusted basis amount, correct?
What's that now?
In a test, they
Yeah.
would give you the adjusted basis amount, but in this question, it's 225,000, the adjusted basis. So I'm just asking, they would give you that information up front.
Yes. Remember, all that basis is based on problem 1, where we figured out, we did all that and got the basis of 225. We said the house was 250 plus improvements minus depreciation. Okay, and that's how we got the 225.
I got it, I just didn't see the page.
Where all of these were using that same 225. Okay, number 4. Mr. Trump sold the rental house to Mr. Obama. Oh, that's different. For a rental house with a basis of 225 and a fair market value of 500. Trump gave 7,000 plus his rental basis of 300 with depreciation of 150. So Mr. Trump sold a rental house to Mr. Obama for a rental house with a basis of 225 and 500,000, and Trump gave $7,000 plus his rental property basis of 300 less depreciation. So if you have 300 less 150, your adjusted basis is 150. Everybody good with that? Okay, so the amount realized is 500,000. And what did Mr. Trump give him? He gave him a basis of 150 plus $707,000. So that's 157. You subtract the 157 from 500, and you have a realized gain of 343. Okay, everybody sees you have a recognized gain of what? 0, because Mr. Obama didn't give Mr. Trump anything but his house that's got a fair market value of 500 grand. You only have a gain if they give you something else besides property. Okay, so recognized gain 343. No realized gain 343. Recognized gain 0. And they would probably ask you what's your recognized gain in that, just to be tricky. So what is the basis of Trump's? His old house had a basis of 150. He also gave up $7,000 in cash, so his basis of the new place is 157. We've now covered almost all the problems they can ask you, either like-kind exchange, regular. This is pretty much all of the combinations. And it tells you how much is the basis of the new property, how much is the old property. Okay. Any questions real quick about all this? We are done with this chapter. This is probably the biggest chapter. It has the most. This one and the last one will have the most questions, sort of. And they'll be the questions with the math. If I can get you to do one thing, write it out. If they have dates, put the date, put the basis. Say the word realize. Everything they got is what they realize. Basis. The basis is the beginning basis plus adjustments minus depreciation. Okay? Realized is everything they got minus selling expenses. The realized gain is what they realize minus their adjusted basis. Gives you what they realize, and then you have to calculate how much of that is recognized gain. And then follow the bouncing ball to do the bottom. And you've got a lot of problems in here, and you use this sheet. Hopefully you'll be able to get through them and make sense. All right, so we've, this was the short chapter with a lot of problems. Now we're going to go to IRAs. This is going to be a quick one. And I will try to get you out of here by 8 o'clock. Okay. Does anybody need a rest, a bathroom break? A shot of tequila? Just kidding. Okay. So everybody knows this one is going to be individual retirement account, IRAs. In part 2, we're going to get into the other parts of a lot of the retirement plans from the business side. More of this, the SEPs, the simples, the 401ks, and all of that. But you're going to need to know this. What do you want? You need to know the contribution, the distribution. Huh?
Are you saying anything important?
No, we're just getting started with IRAs. I'm just trying to give them an overview. I keep leaning back. So for some reason, when I lean back, you can't hear me very well.
Not at all. The microphone just doesn't pick you up at all.
I don't even know where the microphone is in this.
Well, it's close to wherever you are right now, because I can hear you perfectly now.
Okay, here we go. We're going to go IRAs. An IRA can be set up at most banks and other saving institutions, mutual funds, stockbrokers, and insurance companies. What you can't have is an insurance policy. An individual who receives taxable compensation is not over 70 and a half. Okay, you can set up you can have an IRA. One of the things you're going to know, you need to know that at 70 and a half for IRAs, you can't put money in an IRA anymore. Okay, so what is the contribution limits? The contribution limit is $5,500 if you're under age 50, $6,500 if you're over age 50, or your compensation, whichever is less. So if you make let's just say you're single and you're under 50, you can get, as long as you make more than 5,500, you can put 5,500 into your IRA. Everybody's good. This is pretty common stuff. If you're married and you make enough money, you can put enough for yourself and your spouse. You and your spouse are both 30 years old. You make 50 grand, your spouse doesn't work. You can put 5,500 in for you and 5,500 in for your spouse. Everybody good with that? So there's one catchy trick when you say, what is your income limit? They did that earlier, but I'd seen it before. So your income is 50,000 and you want to put, your spouse doesn't work. What is the income limit for your spouse? For you, it's 50,000, but you subtract your 5,500. And hers would be 44,500. It's a trick.
Can you repeat that?
Okay, you made 50,000, but you've got to subtract the money you put into your IRA before you count your income has to be. Let's just make it more. Okay. Now we're going to make it a little more complicated. Your total compensation is 10 grand. You want to put 5,500 in for you and 55 for your wife. You subtract the amount that you put in for you, and now the limit that you can put in for your wife is 4,500. Now do you get it? Okay.
Into IRA.
But the question, it's going to be way above, but they want you to subtract this 5,500. What is the income limit for the wife? So, but it doesn't say it exactly like that.
So the-
Okay, what is compensation? Go
Sorry,
ahead.
so the limit for your spouse is your wage minus the
5,500.
Okay.
6,500 if you're over 50.
Okay.
Okay? What kind of compensation? Wages, salaries, commissions, self-employment income, alimony, and separate maintenance payments. Alimony counts for putting into the IRA. Now, next year, what happened in 19? If you have old alimony from the old rules, you're still good. But if you get a divorce now, your alimony is not taxable to the person you give it to, and it's not deductible for the guy that gives it. So let's say you've got a husband and you have to give him $20,000 of alimony every year. Well, in 18, you had a divorce and you gave him 20 grand for the next however long. Well, that 20 grand was income to him and deductible to you as an adjustment. No, that's not going to be that way anymore. But that'll be on next year's test because that applies to 2019. So I'm not sure if they'll even have much of that on there. But the point is, alimony is counts for your IRA this year. Compensation you get from things like S-corps, deferred compensation, pensions, IRA distributions, deferred comp distribution, interest, dividends, none of those count for IRAs. It has to be compensation. Okay, if you're in a pension plan at work, you have limits on what the income you can make before you can't deduct the IRA. Normally, you get to deduct an IRA. You have $5,500 you put into your IRA. You make $50,000. On your adjustment, you get to deduct the $5,500. Everybody good with that? If you're in a 401k or could have been in a 401k at work and you make too much money, you can't deduct your IRA. You can still put the money in, it's just a non-deductible IRA. So you don't get deducted, so you have to fill out a form 8606 and it becomes non-deductible. you now have a basis in your IRA. So when you took the money out of your IRA 20 years down the line, if you'd been keeping all these records and filing the forms right on your tax return, and let's say that it's $5,500, you don't have to count, when you take all the money out, that $5,500 you didn't get to write off on your tax return, you don't have to count it as income now. The chances of everybody keeping all those good records is not so good. I had somebody that once, luckily they had all their tax returns, and we had to go back, tax returns, and write a letter to the IRS and prove that they had the basis. They weren't taking it out that year that we were doing all this, but we wanted to get it on the record that they really did it before they lost all their documents and tax returns. And so, okay. Deductible contributions, if you and your spouse want to put money into an IRA, if you do not have a 401k at work, but your wife does, it has a much higher limit. And it starts phasing out between $189 and $199. Okay, so you can make almost up to $189,000 between you and your wife, and not have to, and you be able to write off that $5,500. If you got between $189 and $199, you could only write off maybe a portion. Let's say you were halfway between $194, then you'd only write off half of your $5,500, $27,500. Okay? And they've even had those problems before. But does everybody understand what I'm talking about? If you're in a pension plan, this only applies. If you're not in a pension plan, you're single, you can always write it off no matter what your income. If you or your wife are neither one in a pension plan, you both can write off the $5,500 no matter what your income is. But if your wife is in a pension plan and you're not, you can write off so much. If your income is, let's say, 150 grand, you can write off that amount. On the other hand, your wife couldn't, because she's in a pension plan, her income levels are lower. Everybody got that? Okay. Tax-free distribution of cash. You can roll over, I have an IRA with 100 grand. I can roll it over to another IRA, no problem. I have a 401k, I can roll it over to an IRA, no problem. If it goes through the financial institution and the money doesn't touch my hand, no problem. If the financial institution gives me that 100 grand, I only have 60 days to get it into that other IRA, or it becomes taxable to me. Everybody good with that? It's even worse. When they give me that 100 grand, generally they're going to withhold 20% or 20,000. They only give me 80,000. If they only give me 80,000, I've got to reach into my pocket, pull out another 20,000, and put in 100,000, or that 20,000 they withheld becomes taxable. Everybody get that? And if I did that, pull that 20 grand out of my pocket and put 100 grand into a new IRA, I've got a giant $20,000 withholding coming on my tax return. I'm going to get a really big refund because they got $20,000. I get the whole thing back.
You should put in the 20,000 to make it 100,000.
Yes, and I'm not sure if there's a way for you to say, I want to opt out of having any withholding on that. But generally they withhold 20%. Okay. An indirect or direct rollover is the funds go from company to company. Indirect rollover is they go through your hands. In that case, you got 60 days. Okay?
That 20% withholding, is that federal withholding?
Yes.
Or
that's federal withholding, no penalties involved.
Under 10%.
And it's really hard for them to get them to withhold for the state. Sometimes they will, but most of the time, it's like pulling teeth out of a mad bear.
Is it required, is it required from the
Withholding?
financial-
Generally, so that you'll pay your taxes.
Okay, so they won't just trust, I promise I'll put it in another IRA. No, okay. I don't know.
So trust me,
Wouldn't the burden be on the taxpayer, not the
it is.
financial institution?
Uh-huh.
So,
And I believe I know that some cases, there's no withholding, they can opt out. But if you don't do that, they usually withhold some. Sometimes I've seen it 10%, sometimes 20%.
20%.
Okay. Here on page 309, number D, distributions that are not qualified, distributions eligible for the rollover, required minimum distribution, hardship distribution. There's a whole list. All you gotta do is memorize them. For other than that, I can just read them to you. Okay, what about inherited IRA? If you inherit an IRA from anybody except your spouse, you cannot put money into that IRA. You cannot call it your own IRA. You have to start taking the money out, and you have to have it distributed by the end of the 5th year following death. Okay? I actually had that happen for a few times for my grandmother, my mother, both left IRAs, and my brother and I got them. We each got half, and we had to take the money, and there was rules, and we did. Very well. They had to die though to give it to us.
But,
They were old. My grandmother was 92,
Oh, wow. Live the life.
in
Yeah.
Canada,
and they had to take her ladder away from her to keep her from climbing up on the house to do stuff. She lived on a farm. She'd done this her entire life. She did not want to stop doing stuff, which is part of the reason she made it to 92.
yeah.
Yes.
Okay. If the IRA is from your spouse, you have a lot of different choices. You can change the name to your name. You can transfer the money to another IRA. So you can just transfer the name, keep the money in there. Transfer it to another one of your IRAs, fine. Okay? Only who? The spouse. Okay? So go to 310, net unrealized appreciation. You have an IRA, and in that IRA, they're running a business, then you could have some problems. Just read that little thing. Collectibles IRA is prohibited from investing in collectibles, so you can't put your IRA in fine artwork, any kind of collectibles. The exceptions are gold coins, silver coins, platinum coins. That's about it. You can't put it in just gold. It'd have to be those coins that we just listed. So generally an IRA is prohibited from investing in collectibles. Those exceptions were the only ones. There's also a bunch of other prohibitions. You can't use it as a security for a loan. You can't sell property to it. So you have an IRA with $100,000. You want to sell your swampland in Florida to it for $100,000. Wrong. And then you'll lose money, and you just broke even with your swampland, or you got it as company. You can't do that. You can't sell land to it. You can't take it use it as security. You can't buy property with it. Everybody pretty good with that?
What do you mean by sell land to it and buy property with it? You can buy, I don't understand sell land to it.
Okay, I have an IRA that's got $100,000 in it. I own a piece of property worth $10,000, fair market value. I sell that piece of property to my IRA for $50,000. I just made $40,000 in capital gains. I pay my capital gains tax. My IRA takes it out it loses money. That's not okay. Okay, you know that your IRA can have other than cash, right? So, you have an IRA, and it's with like a Fidelity, Vanguard, somebody like that. They don't keep it in cash. But they buy stock with it. They could actually put it in REITs. They could put it in other kinds of investment. They could even buy property with it. But you're gonna have them doing it. You can't do that. They are a third party, and they're more likely not, they're under fiduciary rules, and if they do a bunch of shenanigans, let's see, what is it? It's either 50 or 100% if they don't pay it back immediately. So they get fined 100% of the money they took. So that's gonna kinda slow them down. Okay? And no matter what, you can't use the IRA. Take the money and use it for your personal use. The money's in the IRA. You don't give yourself a distribution. Okay, do you know that you can control your own IRA and technically give yourself a little bit of money for running your IRA? So I have $100,000 in my IRA, and I invest it in the stock market. That's not illegal. It's in the stock market. On the other hand, I give myself $10,000 a year for doing that investing. That would be illegal. I gave myself only $100 for doing the investing. That would not be. They don't like you cheating your IRA. Okay, basis on a traditional IRA. So, remember, we'll say that I wanted to put, we'll just say $5,000 into my IRA. But this year, I'm single, and my income, I could have joined my 401k this year, but I didn't do it. That's my fault. I could have been. So, I didn't, and so then, at the end of the year, let's just say I make $100,000. Then I'm above the limit to put money into an IRA. I can still put the money in, I just can't deduct it.
What's the limit?
Huh?
What's the limit?
It's on your page there. I could have put up to $5,500. No matter what, I can put the money in, but I can't deduct it. So I have to have, there's a form called the 8606. This is a form. You need to know that number, 8606. And what happens is, now, I don't get to write off the $5,000 as an adjustment on my tax return, under adjustments. But what I have now is I've got a basis in my 8606 of $5,000. So let's say the next year, my income goes down because I get a crummy job, and my income goes down to $30,000, and I can put the $5,000 and I can write it off as an adjustment. So I write the $5,000 on my tax return. So now I've got $5,000 and $5,000. This $5,000 is basis. This $5,000 is not. And when it comes out, I have to pay tax on this. When this comes out, I don't have to pay tax on it. You understand? Because I didn't get any write-off for this first $5,000. That one I got a write-off, it reduced. So, and we'll say that I now got $10,000, and I earned $100. So I have $10,100. So if I took out all $10,100, I would have to pay tax on this and this, but I wouldn't have to pay tax on the $5,000 that I didn't get to write off. That the 186, the form itself, they're gonna ask about that form. They even have a question, what form, for your non-deductible IRA does it go on? 8606. It's under basis in traditional IRA on page 310. Okay. Okay, normally you can put money in the year into an IRA, and then later on you can change your mind and recharacterize it and send it to another IRA. Okay? Starting now this year, you could put money into from a traditional IRA to a Roth IRA. From what are the kinds? SEP, simple maybe. A conventional from a traditional SEP or simple to a Roth can't be recharacterized anymore. So before you could put your money into the Roth IRA. This happened in 2008. The stock market crashes. So you're paying tax on $10,000 that you put into your Roth IRA that's only worth $5,000 now. So what you would do is put it back into your traditional IRA or a different IRA, and so then you don't have to pay tax on $10,000 that's worth $5,000. A bunch of people did that back in 2008 because the market crowd. If you guys remember, the market crash went down to half. Not a good year to be a stockbroker. That's on page 311, and it says before TCJC, then married filing separately. We haven't mentioned that. You know that all these limits for married filing joint and single, if you're married filing separately, and you live with your spouse at any time during 2018, your modified AG is between 0 and $10,000, you can't contribute to a Roth IRA. When your modified income is over $10,000, they may have that one. Okay, so you put money into your Roth IRA, your traditional IRA, your SEP, your simple, your retirement plan, whatever. There's a retirement savings credit. What are the rules? To put money, to get that retirement savings credit, you have to be at least 18. You can't be somebody's dependent. You can't be a full-time student. Okay, if you're not any of those, and you put money into a retirement savings credit, you can get a credit. But it's really chinchy. They've got the income level so low, most people can't do it. So, if you're single, you got to get the 50%, you got to make AGI under $19,000. How many people can afford to put a bunch of money into? Okay, 19,000. Are you kidding me? And if you make more than 31,000, you don't get anything. That's not so good. Married filing joint, it stops at 63. The people that can afford to put money in IRA are not making 19,000. Just some idea. Okay, what is the amount that you calculate? So it's got a limit of a married person 4,000, single 2. So you don't get to write off more than $2,000. So if I made under $19,000 and I put $2,000 into my IRA 401k, then I would get a 50% credit. If I made between $19,000 and $20,500, I get a 20% credit. Okay? Or I don't know if they would be so picky to make you learn all of that. I don't think so, but you got to know that it changes with the amount of income, and it's really low. Just read about unrelated business income. Okay, what kind of penalties can we have on these IRAs? There's two kinds really. They're only gonna really ask about. One, 6% penalty for putting too much money in. 10% penalty if you take the money out before age 59.5, and there are some exceptions. So let's go over. So on page 313, if you put more than excess contribution, you're under 50 years old, you can't put him at 5,500. If you make a mistake and put 6,500, you've got $1,000 excess contribution. You've got to take that money back out before the end of tax season, or you could have a 6% penalty on that.
So you can get both penalties.
No, you wouldn't get both. If you took the money out on excess contribution, you don't have any penalty. So you found out at the end of 2018, you've got an extra $1,000 in there. So before you file your tax return, you take the money out. No harm, no foul. Okay, the next year, you found out and you just roll it into the account for the next year. You're fine. If you take the $1,000 out, you have to take the $1,000 out, and we'll say you earn $50 interest. The $50 interest you earn is income, and you'd pay a 10% penalty on that. 10% penalty on $50 is only $5. Not gonna kill you.
I thought there was no limit if you don't have a company retirement plan.
You still can't put more than 5,500
55 is a limit.
unless you're over 50, then it's 6,500.
Over 50, but
Yeah.
under 65.
Okay, what we're talking about is limit. 5,500. You can have an income limit. If I'm not in a retirement plan, I can make $1 million and still put that 5,500 in there. But on the other hand, if I'm in a 401k plan, what was it over here a couple pages back? A single guy can't make over 73, he can put 0 in and deduct it. He can put the money in, he cannot deduct it as an adjustment. Okay? But he still can put the money in.
Up to 55.
Yes. Up until yes. At 50, he can put up to 5,500 in, no matter what his income is. If he has no pension plan, no matter what his income is, he can put in 55. If he has a pension plan that he's in or could have been in, he cannot deduct the 5,500. He can still put it in. Go ahead and just read the excess contributions. They're liable to ask you what happens if you leave it in there the second year, then you can roll it into your next year's IRA. So you put in an extra $1,000, count it as next year's IRA. Premature distributions, that's the biggie. That's what we always see, people taking it out before they're 59.5. Here's a list of all the exceptions, not exempt, exceptions.
What page?
On page 313, on the bottom it says premature distributions. Here's the exceptions. Okay, so if you die, you get to take the money out. Actually, your estate does, and there's no penalty. No matter what, when you take the money out, unless it's a distribution that you didn't get to write off, that was a non-deductible distribution, you pay tax on it. I have 100 grand in my IRA. All that 100 grand I've been writing off as an adjustment on my tax return. When it comes out, no matter who it comes out to, I'm dead, I'm disabled, I'm what, I pay tax on that. I just get out of the 10% penalty. If you take it out before 59.5, there's a 10% penalty. Okay, here's all. You take it out as an annuity. You take it out monthly over the rest of your life, there is no penalty. You take it out for medical expenses more than 7.5%. Higher education up to $10,000. Qualified first-time home. Oh no, think education you can take out whatever you use for the tuition. First-time home buyer, you can only take out up to 10 grand. Unemployed health insurance premium. You're unemployed and you use it to pay your health insurance premium. You got to pay tax on it, but you don't have to pay the 10%. Everybody got that? What happens if you borrow money against your IRA or you did any of those prohibited transactions? You bought land with your IRA. Your IRA, as of the first of the year, the whole amount becomes taxable. It's no longer an IRA. So you borrowed you borrowed against your IRA 10 grand. Your IRA is 100 grand. Well, that whole 100 grand now just became taxable and a penalty. After you turn 70.5, you have what's called required minimum distributions. That means you got to start taking out a percentage of your IRA. People like moi. Every year they make me take out money out of my IRA. It's actually a pension plan rolled into an IRA, but they don't care. It would apply to your 401k too. So what does that mean? Let's just say they take out 5% a year. If you have 100 grand, they have to take out 5%. There's a formula for that, depending on how old you are and other things. Okay, so they make me take out 5 grand a year. I have to take it out. Usually your company that you're with keeps track of all this and they just do it. They know it. Okay, but you have to take it out. What happens if you don't? If you don't take out the required minimum distribution, you're penalized at 50%, half. You know this, huh?
Yes, sir.
If you've had clients, you can, if you've got reasonable excuse, you can pay the tax and then fill out, is it a 5329? And send it in and try to get your money back. Usually they're good about it. If you go, you have a little old lady and she has her money in Fidelity and Fidelity forgot to tell her and she goes, I didn't know, blah, blah, blah. And she's just turned, this is her first year, you all pretty much win. But if you've done this, you've jerked them around before, not so good. Okay, what do we have then? Roth? Oh, you can borrow from your 401k plan. I don't know if they say it here, but it has to be in the contract, the 401, it has to allow that. But say you can borrow up to 50 grand or half of the plan or 10 grand, whichever's smaller. And you got to pay it back within 5 years and you got to give it at least quarterly. Most companies take it out of your pay monthly. Okay, so you work for a big corporation, they let you borrow money, then they take it back. Now what happens if you quit that company? Boom, the whole thing is taxable at that minute. Or minute or day or hour, whatever. Okay, Roth IRAs, exempt distributions. If you put money into a Roth IRA, you leave the money in there for 5 years and you become 59.5, when you take the money out, it's tax-free. Okay? There's income limits. Single people they can't make over, they start phasing out between 120 and 135. Married people between 189 and 199. And look on the bottom of 315, they say modified AGI, you add these amounts back to your AGI. So, real quick. I've got 100 grand in my Roth IRA. It's been in there 5 years, but I'm only 57. Out of that 100 grand, I put in 75 grand. Okay? I go to my Charles Schwab guy and I go, I need some money bad. And I go, he goes, well, the only thing, you got an IRA,